So we were discussing about spin-off. What is this spin-off all about? Spin-off is the transfer of assets that constitute an entire division. That means you have assets in some division, okay, or in some subsidiary company. That means a company has certain assets in B company, which can be a division or a subsidiary. And what they are doing is they are transferring the assets like from this subsidiary company into a new company. Okay, that means here I would like to say they are turning a subsidiary into a new and separate company. Okay, so like creation of a new independent company by selling or distributing new shares of existing business, or like if I have to say more in more detail, new and separate company is created when a parent company distributes shares in subsidiary company or business division to parent. Just a second, just a second. Okay. Yeah, so what they're doing is they can sell a company to start a new company, create a new company. Okay, so in spin-off, they are transferring the assets that belong to a subsidiary. Okay, they can transfer these assets into a new company, or they can sell these assets and form a new company. Anything is okay. Upon which the shares of Spinny are subsequently distributed to the shareholders, and shareholders do not surrender any stock of the spinner. That means the assets are transferred into new legal entity. Okay, and after that the shares of that company are distributed to the shareholders, and the shareholders do not surrender any stock of the spinner. So here the diagram is given. You can see before spin-off, shareholders of company A. Okay, and then there is this company A, and we are speaking about the shareholders of the company A. And then company A had shares in company B as well. So company A's shareholders were the shareholders of company B as well. So before spin-off, company A, the spinner. So the company A, like who is going to do this spin-off? Okay, who is owning the B company? So company A owns B company here, and the company B is the spinny. So spinner, spinny. So company A owns company B. So here the investor is nothing but the spinner, investee is nothing but the spinny. So before spin-off, company A owns company B. Yes, we can see that here with the diagram. It is very clearly like evident. And and shareholders just have shares in company A. The shareholders have shares in company A. That you should understand. See, I'm again explaining you. Before spin-off, shareholders of company A have shares only in company A, and company A has stakes in company B. So before spin-off, company A, the spinner, owns company B, and shareholders just have shares in company A. They don't have shares in company B. But after spin-off, the shareholders have shares in both company A and company B. Company B is no longer included in the consolidated accounts of company A. That means this has become a separate company now. Okay. So before spin-off, parent and subsidiary. After spin-off, two separate companies. Okay. Now after spin-off, what is happening? Shareholders have shares in both company A and company B. That means company A's shareholders, okay, have shares in company B as well after spin-off. That means they have converted this subsidiary into separate company, and the shareholders of this particular company now have bought or purchased the shares of this company as well. You can see here the statement was given. transfer of assets that constitute an entire division or subsidiary. So subsidiary company has been transferred or has been made into new legal entity upon which the shares of SPINI, that is this company, subsidiary company, are subsequently distributed to shareholders, and shareholders do not surrender any stock of the spin-off. That means the shares of company B. Now clearly company A owned company B. Company A has the company A had some shareholders. So in spin-off, company A has transferred the assets of this subsidiary into a new legal entity. Okay. Okay. Either that or they have sold the assets and sold the assets of this company, or they have made this a separate company. You can think also in that way. Okay. And either they can buy the assets and put into this company, or they can sell the assets of this company and start a new company. Anything is all right. And in this case, what has happened, what has happened is, as this company has become a new legal entity, this company's shares has been distributed to the shareholders of company A. Okay. And shareholders of company A has not surrendered any stock what they held in company A. That is what is spin-off. So the shareholders of company A have the shares of company A with them, and also they have the shares of company B with them. They have not surrendered or not exchanged any shares of company A with company B. That means taking company B's 5 stocks and giving 2 stocks of company A. Nothing of such kind has happened. Simply company A had a subsidiary. They made it a single. They made it a separate entity. And as they made it a separate entity, the shares of company B are now held by the shareholders of company A, and also the company A shares are also held by the shareholders of company A. Now shareholders of company A has both shares of A company and B company, right? That's what. And now these two are separate legal entities and they are not going to make group accounts. Once the spin-off becomes probable, that means it is going to happen in the future, the balance sheet assets and liabilities of SPINI will be transferred from assets held for use to assets held for sale. Yes, now as company A has decided that it is going to do a spin-off, what it is going to do, whatever the assets of company B it had with itself, that means the SPINI's assets were held by the spinner, right? So spinner has now decided that instead of assets held for use, they will transfer them to assets held for sale. Okay. In their accounts itself, in the spinner's books itself, they'll show that assets held for sale may be referred to as assets held for distribution in this context. No profit or loss is recorded in the disposal of income statement. Now, disclosures, I'm just going to read out certain points in this. Under IFRS firm, so please tell me, everyone understood the spin-off concept? Yes or no? Please tell.
Yeah, sure.
Bhargav, Isha?
Yeah.
Yeah, okay, Bhargav, I got it. Okay. Long-term asset disclosures. Now, what are you going to disclose regarding the asset which you are showing in the books? IFRS disclosures. Under IFRS, the firm must disclose the following for each class of PPE. How are they going to measure the asset? That means usually, initially the assets are always measured at historical cost. What method of depreciation, depreciation expense, useful lives or rate of depreciation, gross value and accumulated depreciation at start and end of the period, reconciliation of carrying amounts, that means what was at the beginning and what is at the end. Firm must also disclose the following: title restrictions and assets pledged as collateral. That means if you are using the assets what you are holding, you have the title deeds, right? If you are using them as collateral and taking loans, you have to disclose that. Give me a second. agreements to acquire property, plant and equipment in the future. If they want to acquire PPE in the future and they have made some agreement, see what happens. Company A wants to buy a machinery in the future from company B, and they make forward contracts of such kind that they'll buy the asset at some pre-determined price. In that way also, if revaluation fair value model is used, the firm must disclose the following: when they are revaluing the asset, how fair value was determined, that means how the market value they have determined, whether they have called a professional valuer to do that, or they have surveyed in the market what's the price of that asset, what is the price of that asset is as on today. Then carrying value is using historical cost model. That means every year assets value will be depreciated, and the carrying amount of the asset will be shown in the books. Then revaluation surplus, if at all the company has gained, company has a revaluation gain, then they have to show in the OCI section. Under IFRS, the disclosure requirements for intangible assets are similar to those for PPE. Like what you have seen for the property, plant and equipment, the same thing goes for intangible asset as well, except the firm must disclose whether the useful lives are finite or indefinite. So you know, for definite assets, amortization; for indefinite asset, only impairment review like goodwill. For impaired assets, the firm must disclose the following: amounts of impairment losses, reversals by asset class, where this is related to IFRS, where the losses and loss reversals are recognized in the income statement, and circumstances that where, that means where, WHER, this is not WERE, where, that you have to recognize, but where will you recognize them? Like in the SOPL or OCI, etc. Circumstances that cause the impairment loss or reversal. How, what was the reason for impairment loss or reversal of impairment loss? How did that happen? In what circumstances it happened? US GAAP disclosures. Under US GAAP, property, plant and equipment disclosures include the following: depreciation expense by period. So you have to show what is the depreciation expenditure. Balances of major classes of assets by nature and function. That means you have like different like tangible assets, right? Like land, any kind of building, machinery, furniture, or any improvement you do. So you have to show the major class of assets by their nature and functionality. Then accumulated depreciation by major classes or in total. General depreciation of depreciation methods used. Sorry, general description of depreciation methods used. Generally straight line method. Here the depreciation method what used in IFRS as per the international accounting standards or IFRS are straight line method or diminishing balance method. But when it comes to US GAAP, straight line method, double declining method, or some of the years digit method. I don't know whether you have come across all this or not. In case of mining, it is depletion method. In case of machine, which your operating machine, are rate method. And production rate method, this is also one of the methods. So there are many methods, but usually in our syllabus we will be only going for these two. There is also one method called MACRS method, that is for the tax purposes. Just giving you extra information, only these two are relevant for you. And so you have to describe which method you are using. Under US GAAP, the disclosure requirements for intangible assets are similar to those of PPE. In addition, the firm must provide an estimate of amortization expense for next 5 years. That means for next coming 5 years, how are you going to amortize the intangible assets? And straight line amortization, of course. For impaired assets, the firm must disclose the following: description of impaired asset, which asset is impaired, circumstances because of which the impairment has happened, how fair value was determined, the amount of loss, if any, where the loss is recognized in the income statement. So we see a lot of similarity between US GAAP and IFRS. So under IFRS, depreciation and amortization expenses may be shown on the face of the income statement. That means, on the balance sheet. If producing an income statement using the nature of expenses approach, that means this is the most important point. If you are using nature of expenses approach, then in income statement you will be showing this on the face. If company prepares the income statement using the function of expense method, what is the functionality of each and every expense? It will not be shown on the face. Instead, it will be included in the cost of sales. Yes, you should be understanding. Many a times what happens, depreciation is taken in cost of sales. I really don't have an idea whether you have prepared statements based upon like you have made the statements based upon IFRS or US GAAP, and there I have seen many a times the depreciation is included in the cost of sales, because factory depreciation or any kind of equipment which you are using in factory, if it is getting depreciated, it is used for the production purpose, so it comes under cost of sales as a manufacturing overhead. Okay, rather cost of goods manufactured. And or you can show in the sales or general or administration expenses if the indirect method is used to produce cash flow from operations. So there are two methods in cash flow which you use to prepare the cash flow statements: direct method and indirect method. Bhargav, have you gone through the videos?
Sir, I
Hello.
went through two videos.
Okay, you got an idea about that.
Yes, sir.
You were able to understand about the cash flow statements, right?
Yes, sir.
Okay. So go through the third one also. There's one more question explained in that, so that you can get a very good idea about the cash flow statement, and we can start the cash flow statements in the next session. Now,
Okay,
so
sir.
when you prepare the cash flow statement by using indirect method, if the indirect method is used to produce cash flow from operations, depreciation and amortization will appear as non-cash charges. You now can really relate this point with the video what you have seen. It's a non-cash expense. Everyone knows. For companies adopting the direct method, depreciation will not be appear in the computation of operating cash flows. Of course, we don't take this. We only take inflows and outflows, and we take revenues and those kind of receivables and money received from receivables and all. There's a format for that. However, under US GAAP, US GAAP requires the indirect method reconciliation of net income to operating cash flows to be disclosed in the footnote. So you have to show the reconciliation, indirect method reconciliation of net income to operating cash flows. That means what you're getting and what you are showing, really it is like that, and you have to show the reconciliation. So cash received on asset disposals, you will be showing definitely that in the investing activities. Or if you are buying asset, acquiring asset, then also when you acquire asset it's a outflow, when you sell asset it's a inflow. You have to show in the investing activities. Now analyzing the long-lived assets disclosure. Fixed asset turnover shows revenue. What is the fixed asset turnover ratio? By the usage of fixed assets, what is the revenue you're going to generate, or how efficiently you're using your assets to generate your revenues. Let's say your revenues are 10 lakhs and your asset value is 1 lakh. For $1 investment in assets, I am generating $10 of revenue, and if it is more than previous year, it is considered good, because the higher the ratio the better it is. Why? Because with $1 if I can make $10, with $1 if I make $12, this is a better one, right? So this shows a more efficient usage of asset to generate more revenues. Financial statement disclosures provide an analyst considerable information about companies' fixed assets, depreciation, amortization methods. An analyst can use the data to estimate average age of firms' assets. The average age is useful for two reasons. We have yesterday done this, right? So I don't want to discuss. This is done. So we are done with this chapter. Okay. Let's see what we can start. We have only just done 20-minute session. Okay, we have still we have good time. So I'm calling in 5 minutes. Okay, and we'll start a new topic. Anything left in this chapter? Done, right? Okay, okay, done. I'm calling in 5 minutes.